Quantitative tools employed by the Central Bank of India are essential instruments in macroeconomic policy, primarily utilized for managing the supply and regulation of money in the economy. These tools have broad applications in controlling inflation, stabilizing the currency, and ensuring economic stability. Bank rate represents the interest rate at which the central bank provides loans to commercial banks. Alterations in the bank rate influence all interest rates in the economy, including those affecting consumer loans and deposits. Raising the bank rate discourages borrowing, reducing money supply, and controlling inflation. Open market operations, OMO, involve the buying and selling of government securities in the open market. When the central bank sells securities, commercial banks' reserves decrease, leading to a contraction in the money supply. Purchasing securities adds to bank reserves, increasing the money supply. Cash reserve ratio, CRR, requires commercial banks to keep a certain percentage of their deposits as reserves with the central bank. Raising the CRR reduces funds available to banks for loans, controlling excess liquidity and inflation. Lowering the CRR enhances liquidity and fosters growth. Statutory liquidity ratio, SLR, mandates banks to maintain a proportion of their net demand and time liabilities in liquid assets before lending. Increasing the SLR restricts banks' capacity to sanction loans, checking inflation. Reducing the SLR promotes lending and investment in the economy. Repo rate is the rate at which commercial banks borrow funds from the central bank against securities. An increase in the repo rate makes borrowing costlier for banks, leading to reduced lending and curbing inflation. A decrease encourages borrowing and boosts economic activity. Reverse repo rate is the rate at which the central bank borrows money from commercial banks. Increasing the reverse repo rate attracts bank deposits, reducing money circulation and dampening inflation. Lowering this rate discourages depositing with the central bank, enhancing money supply. Through these quantitative tools, the Central Bank of India meticulously balances the money supply to achieve desired economic outcomes. Each tool is employed with precision, taking into account prevailing economic conditions, ensuring stability, and promoting sustainable growth. These instruments are pivotal to national economic policy and serve as benchmarks for fostering investor confidence and market stability. The apt utilization